Okay, great. So the next one is this matter of business relationships, which we've talked about. The key issue here, if in doubt ever, is that if we're which is why I mentioned at the beginning of this chapter four, this series on chapter four, was very much about independence. So it's a matter of independence, and if you feel that right, if I need to ensure independence, we shouldn't be having certain business relationships. I mean, some things, so you would make you wonder. For example, here it says if the audit firm enters into a business relationship with clients, for example, like joint ventures or marketing arrangements, you would wonder, right? Of course, this will lead to some kind of self-interest because you would just expect you'd have an interest in their business, so you just can't quite manage that if you have these type of relationships. So typically, you can see here, really, is there really a safeguard that can prevent this type of interest? So really, you just should not be having these relationships in effect. So don't get weighed into thinking, oh, it's a small amount. No, just anything that's really affecting your independence. You need to. And you also want to highlight to the examiner that expression. You don't just want to be independent. You want to be seen to be independent. So in the case of the audit team members, the individual with a connection should be removed. If someone does have a connection in any capacity, any kind of business relationship, take them, take them out. Um, and here, the purchase of goods and services from an assurance client would not normally give rise, as long as if things are in the normal course of business in commercial terms. But if they aren't, typically you want to take that person off the audit team. That's your go-to, and you're safe once you put that together. Once you put that together. Now, you do have people who will work in practice, very normal, and then they will, after a while, potentially once they qualify, join the client, very normal. And pretty much because they've built a relationship with that client whilst in the audit, or it might just have been a one-off, moving there as a financial controller, kind of financial director, sort of growth path. And so if we do have this scenario, if the potential, it says here, you can see the word is potential. So typically there is no potential at the time, until you finish technically. But if there is awareness that something could happen, there was potential, then of course what we want to do is remove the individual from the assurance engagement straight away, because we don't want anything, we don't want anyone to come back and say that, of course, that maybe there was a potential for a favorable opinion because we wanted, to join the client later on, and we wanted to please them. And so it's almost that's almost a mute point. I'm sure you would pick that up and reject that and say no. But the key point here, the policies and procedures of the firm should require such individuals to notify the firm of the possibilities. A lot of disclosure and actual carrying out some kind of action to protect the firm. Contingent fees. So, I mean, that's another one that you can see. You'll get that a lot. This kind of dependency. When I say dependent on getting an, if so the client says to you, listen, if you give us a good audit, we will pay you X. We won't pay. I mean, this is an intimidation threat, really. Ultimately, I mean, it's a self-interest, but somewhat technically you could almost look at it as intimidation as well. But the idea here that we would give our audit fee based on a percentage of the profit. Now that's another sort of example here. So the more profit they had, the more fees you would be able to extract is just not even possible. That just should not happen, if you like. So your fees should be set at a consulting amount, not some kind of dependency amount on profit. Right, and so they're just not. It's just not allowed. There is no safeguard. You shouldn't just do it, right? Um, and finally, again, this question of, well, this is interesting. This is almost new. I think it's the first time I'm seeing this, or not seeing this for a while. I don't remember this last year. But the idea here that when a member of the audit team is evaluated or compensated for selling non-assurance services, if you like. Now that's also that does happen. You do have, again, people trying to sell tax work or tax consulting, that we can do your tax for you as well, and we can even manage your internal controls, and we can do your payroll, that sort of thing. Then that's not right. That's not right. Again, really, again, it's about the levels, isn't it? Um, if you like, of who's selling that service. So if it was a key partner going in there, then their issues ultimately. Again, I want to be careful here because if we're talking about non-listed firms, you do have a lot of this, if you like, going on. People are constantly, working and trying to expand their portfolios. And even with a client, there's no rule against it. We had benchmarks for total fees, so it does mean that people can do sell other services. So you can see here, a key partner shall not be evaluated or compensated based on their success in selling non-assurance services to their audit clients. So no one's against it, but you just should not be compensating you for it based on. So yeah, because because there's a threat again, a self-interest threat. And typically, by the time we get to litigation, we are in the zone of a breakdown in the relationship. So really, there's a breakdown in trust between the auditor and client. And once you have that, it is very difficult to state that you're still um, able to carry out your work objectively, if you like. And typically this is based on a prior assurance engagement, a prior relationship, but there's something, there's a problem. So I mean, if we can somehow either get another partner or another group to carry on the job, that's great. Maybe possible to continue other assurance engagements depending on the significance of the threat by discussing the matter with the client audit committee. If we remove the person in particular who's concerned, it might work, or we could obtain an external review of the work done. The key point is, if adequate safeguards cannot be implemented the firm must withdraw from or decline the engagement. Yes, decline that. Good. So that's kind of what's going on um, there as well. So let's carry on with the next threat, familiarity. We talked about familiarity, but just again highlighting some of the safeguards, some of the big ones. So again, you can see with this question of the key issue here is I think we saw a case where I think I remember talking about Tesco's when we did chapter 1 to 3, where PricewaterhouseCoopers as at up to 2014 and 15 had been Tesco's auditor for 31 years. So there's an issue there somewhat, and that's a long time, isn't it? So, I mean, the threat here is that you have the same senior personnel in engagement over a long period of time, trusting, really less skeptical of the client because you've been doing it for such a long time. So they should consider the length of time, the structure, um, and we'll talk when we come to talk about the engagement letter. We'll talk a lot about understanding the management team and understanding the subject matter. Maybe that's evolved over time. So we need to document these changes every year. And it's possible you get lax because you know the client, and so it's important that you're careful to ensure that you document what's going on and any changes in effect. So what are we saying here? So for your non-listed clients, I mean, the idea is rotate senior personnel. You can see there are no strict rules. Again, like I say, there's just that principle approach, and have an independent partner quality control review, of course, that we talked about earlier on. Um, Now, with listed clients, again, just like we had the 15% for the fees, we also want to be very clear about the numbers here. So key audit partners must be rotated after no more than 7 years with a minimum break of 2 years. So the client remains with the firm, but there should be a new set of partners who take over the job, if you like, and then you should have a 2 year cooling off period before any of the maybe the initial partners were the ones who brought the job to the, if you like, to the firm. So they need a 2 year cooling period before they can um, go back. Now, this is what I was saying about PricewaterhouseCoopers being Tesco's auditor for 10 years. It says large listed companies must put the audit out to tender at least every 10 years. However, this is not the responsibility of the company. This is the responsibility of the company, not the audit firm. So you can see there that again, what this is to enable as much independence as possible, right? So two things there you want to remember: the 7 year rotation and the need to tender um, if you're listed every 10 years. Okay, great. So we now have this question of the familiarity of family and personal relationships. I guess it does make sense you want to remove the individual from the engagement team. So if you have a family member or someone who's quite close, who's able to exert some significant influence on the financial statements, we don't want them on the job ultimately. So maybe the wife of the director, so the wife is in the audit, works for the audit firm, the husband is the financial director at the client. We definitely don't want the two of them working together under any circumstances anyway. Um, Not to talk of, I'm joking, but the key point here is that there's a lack of independence because the wife works for the firm. Problem is that she might go home and talk about it anyway. So the question is, we want to create as much independence. Um, yeah, so I think it's trying to create as much independence by getting them off the team, so they don't have that issue. Um, Let me see if I can finish these before we. Oh yes, good. I can finish these two, and then do the next video on the next one. So recruitment. So sometimes, I mean, this is not impossible. I do remember times when the client will, in conversation with senior partners and audit firms, say, "Listen, we're looking for a recommendation, so to speak. Um, can you help us?" That sort of thing. And for listed firms, so and I mean, I didn't train with one of the big four, so um, the many of the companies that I worked on or didn't work on, they were very close relationships with the partners. They were limited companies and sort of, yeah, listed companies on the alternative investment AIM. So you do have those really strong relationships with partners where they can engage directly and who can advise and support. But with listed firms, the issue here is the firm cannot provide recruitment services in respective directors or senior management who would be in a position to exert significant influence over the financial statement. So really the firm has to go away and do their own. Sometimes they'll invite a senior partner, sit on their board to see whether the financial director is capable. So those sorts of things we want to avoid, right? And then finally, employment um, with the audit client. Um, so typically, again, I highlight that we sort of came across this again, where you have an employee of the firm joining, um, if you like. Um, yeah, we mentioned this question of someone leaving us as the firm and joining an assurance client. So the issue now here is rather interesting. The case here is that if they've left us, if you like, to join this other firm, we don't want our friends. We don't want their friends being the auditors, because if you have their friends with the auditors, then all you have is this kind of cozy relationship, and maybe the fact that they won't do the work as efficiently as possible because they were all friends. And so what you want is an almost new team to kind of go in there and kind of carry out the work, um, if you like, so to speak. So so that they can maintain independence. So for listed firms, so partners joining public interest entities, independence would be deemed to be compromised unless subsequent to the partner ceasing to be a key audit partner. So really what we're trying to say is that if we know that someone is going to be joining this firm, we want to take them off the job at least 12 months prior to them joining. Now this isn't always the case. So if you don't know when they join, that's fine. Um, if you like. We just have to make sure we have a completely different um, team in place that will be able to do the work independently. So, some of the things the firm should consider the position taken at the client, the involvement of the person is likely to have with the audit team, the length of time since the individual was a member of the audit team. So, we want to make sure that we give ourselves enough distance and have a new team in place to manage those conflicts, because you're going in, especially with a new team, to discuss with someone who might have been quite central during who managed the audit. So we need to make sure that we can defend ourselves or protect ourselves from being overridden. in any capacity. Okay, great stuff. And so yes, we'll carry on in the next video with self-review threads.